All right, let's get more on the market's response to today's jobs numbers. And for that, we're joined by David Kelly, Chief Global Strategist at JPMorgan Asset Management, and David Bailin, Chief Investment Officer and Global Head of Investments at Citi's Global Wealth. Good to have you both. David Kelly, let me begin with you. Just give me your reaction to the number and what you're seeing in the markets right now and whether that sort of accords with what you would have expected.
All right, well, it's really a tale of two surveys. I mean, what the household survey said, with actually a decline in employment of 18,000 in the household survey, an increase of 850,000 in the payroll survey. I don't think I've ever seen a difference as big as that. So there is a lot of confusion in the numbers. But what I still see is basically what a lot of you have been talking about, which is there is tremendous demand for labor out there, and it's hard to hire workers. And if you look at the wage growth numbers, one of the things we do is we look back over the last 2 years rather than just back over the last year, because that way you get rid of some of the pandemic distortions. And on that basis, average hourly earnings for production workers have been rising at a 4.6% annualized rate over the last 2 years. And that's the strongest since 1983. So there is tremendous demand for labor here. And I think those wage numbers are strong. I mean, remember, we're adding in a lot of low-wage workers back into the labor market right now. The growth is in restaurant workers, service, hotel workers, and still those wages are climbing. So I see a lot of demand for workers here. And I do think that when those unemployment benefits finally lapse, and that really hadn't happened in the June survey, when that lapses in half the states for the July survey and in all the states for the September survey, I think you'll see a lot of job growth. So I think there's a lot more growth and a lot more potential inflation in these numbers than the bond market seems to perceive.
All right. Back to this wage number that you cited in terms of the actual increase in 1983. Is there anything that any correlation that can be made from that period to this one, David Kelly, that will help people understand sort of what to expect?
Well, yes. I mean, I think when it comes to inflation, I think we're in a somewhat sticky situation. A lot of this is transitory, but I think when workers get used to those wage increases, I think, first of all, the wage levels will stick, but I think some of the wage increases will stick also. People get used to that increase in wages, and it's feeding through to expectations, too. So we're looking at expectations, we're looking at wages are the two things which are likely to make this inflation episode more than just transitory. And we are seeing that in this survey today. And it's not quite back to the 1970s in terms of inflation. I mean, not by a long shot, but it is more inflation than we've seen in recent decades.
David Bailin, given the conversation we're having, given those data points we just got out of the jobs report this morning, we were talking about the 10-year yield under pressure, but we have seen this flattening of the yield curve overall. What is the Treasury market signaling here?
Well, I think it's telling us that this is a transitory moment. We're going through a boom, to David's point. The expectation was 720,000. We've wildly exceeded that. We're seeing wages up. What this means for the economy is that we are going through a boom. That is to say that we're going to have a much more rapid recovery now than we had in 2008 and 2009. We could be at full employment next year in the United States. We've got lots of households with a lot of savings, and they're going to go out and spend that on services in restaurants, in hotels, and airline travel. And so we're going to see a very robust economy over the course of the next, let's say, year to year and a half. The fact that the 10-year is where it is indicative of the fact that the market does not believe, the bond market does not believe that there's going to be the level of inflation that David and I might expect. And the reason is that if let's say you buy a 10-year bond at 145, and inflation turns out to be 2.5%, right, which is just 50 basis points more than it was for the last decade, you would lose 1% a year. You would lose 11% of the value of your portfolio over 10 years if you hold bonds. That's the real loss in value. And that has not occurred for a long period of time here, right? We've just come off a 30-year period where owning bonds was a good thing. So this, from an investor standpoint, is a really critical thing to consider. If investors are not going to be paid to hold fixed income, that is, I think, a tailwind for the equity markets and for certain growthy parts of the markets, like you've talked about in technology.
David Kelly, the way the market, at least on first reflex, has reacted to the jobs number today is to suggest that it buys the Fed time to continue to be patient, right? The dollar index has come down. You saw like 3- and 5-year yields come in. They've been very sensitive to incremental Fed expectations. Is that correct? And what do you think that does mean for an equity investor?
Well, I can see why the market's taking it that way because, I think the one surprise in this report was a 5.9% on the unemployment rate. Remember, the Fed currently expects the unemployment rate to be 4.5% as an average in the fourth quarter. And that seems to be getting more and more elusive. So I think that may have a calming influence on the market. But as an investor, I'd just look carefully at valuations here, because at some stage these yields have got to move. Because if you look at it this way, I mean, if the federal government can borrow at 1.5%, they're just going to keep doing it until the Treasury market cries uncle here. So this is just encouraging tremendous fiscal spending, and we get another surge of fiscal stimulus here. Eventually, those rates have got to move higher, and you just need to make sure you're positioned for that, even though the market seems pretty complacent right now.
Shepard Smith here. Thanks for watching CNBC on YouTube.